In this week's update, what will Trump do now? Powerful signals in precious metals and two-speed markets keep widening. My name is Gary Davis. I'm an authorised representative of Primary Securities, and the information in this video is of a general nature only. It seems every week you could say what a week, and the one just gone was no exception at all. So Trump tariffs were struck down by the Supreme Court. That has huge ramifications, but it's probably unclear at this stage how they're actually going to play out. So we've just got another massive dose of uncertainty. And of course, gold loves uncertainty and fear. And so gold and silver certainly rebounded, particularly on Friday. But more about gold as we go through. So apparently Trump has immediately declared a 10% tariff across the board, but that's only valid for 150 days. So that only takes us through till the middle of the year. So beyond that, we've still got gross uncertainty. And it's probably not the last court battle that Donald Trump is going to lose. So the future really is quite uncertain. The uncertainty rolls on, and that really equals volatility. That's what we've been seeing over the last month or so, a pullback from exponential moves in the market, but the uncertainty is certainly going to continue to keep the volatility up there because markets will be in overdrive trying to forecast what comes next. And I don't think anyone has any real idea what comes next. And if you try to think about it, you're probably doing yourself a disservice because you're probably going to be wrong. So there's no point in trying to anticipate what comes next. There are a number of really well-aligned long-term drivers for not necessarily the whole market, but certainly for sections of the market. And they're around really big picture things that aren't going to change. So I think we're going to see these drivers in force for most of the next decade, maybe 2 or 3 decades. The first one is supply chain duplication by so many countries for national security reasons and also just for general way of life survival reasons. So that means that we've got a lot of duplication and a lot more demand than we would have otherwise had if everyone was playing happily together. Another dynamic, of course, is the sinking US dollar. It hasn't broken through key support yet, but gee, it's certainly looking like it. And all the fundamentals are pointing in that direction as well. And then we've got all the geopolitical forces in many, many places around the world that are just keeping everybody on their toes and anxious. And then finally, the rise of AI and particularly robotics is just adding another layer to the demand for critical metals. So all the things, particularly for commodities, are just all working together to create what I think is a perfectly positive storm, if we can put it that way. So my advice to investors is there are 7 megatrends as I define them. You can define them different ways, but I think everyone knows what we're talking about. And really, there is no need to go outside those megatrends. You know, this idea of broad diversification to manage risk is just rubbish. The 7 megatrends will give you more than you can handle in terms of opportunities. So just do that. Just go where the momentum is. And then once you've identified those and you've worked out the proportions, rough proportions that you would like to operate to, then focus in on the best stocks or a suitable ETF. And by suitable ETF, I mean one where the name or the holdings actually represent what the name implies. And sometimes they don't. So just be a little bit careful there. But why would you want to back anything but the best stocks in each sector or industry group? Kind of defies logic to me. The next thing, and this is really important, and I touched on these things last week and I touch on them most weeks, is to consider your style, because there are so many different styles out there. And unless you're operating in the market according to your style, the things that you're comfortable with, that you can be confident about, then you're already setting up an internal battle, and you just don't need that because your psychology is so important. So once you're clear on your style, so I'm talking about the number of stocks you want to manage. Do you want to be in and out with frequency, or do you want to be more of a long-term holder? Do you want to take a significant position in a particular stock or ETF, and then as the trend unfolds, maybe take some periodic profits? Sit on half for the long term and more actively trade another portion. That's a style. It's up to you to just ponder what it is going to suit you. And then once you've done that, then get at least 2 or 3 times as many targets as you need. And that's very easily done. Because if you only have as many targets as stocks that you want to manage, then you're going to be influenced to chase prices. So if you have 2 or 3 times as many targets as places that you've got to fill, then you can just sit back calmly, patiently, and wait for things to come to you on your terms. And that is the ideal way to invest, not to jump on the latest narrative or maybe stock. Now, on the point of psychology, just stay aware of where we are in the sector cycles. If you wind back a few weeks when gold and silver and to a degree copper would get just going parabolic, then you knew that a correction was just around the corner. So understand where you are. Don't get carried away with the moment. Understand what 5 to midnight looks like and feels like in the market. And if you don't know how to do that, you're not close enough to the market, then you better align yourself with someone that can. And then let the market action take you out. Don't try to second guess where the top might be, because the top can often be way beyond where you think it should be. So once you've identified a bit of a shift in the momentum, then let the market action take you out with an appropriate stop loss. But of course, before you embark on any of these things, you need all the other advice, legal, investment, financial, or any other advice before taking action. Most important. Let's look at American stocks now. The S&P ended up adding 1.1% for the week, and the Nasdaq rebounded and outperformed the S&P for a change by 1.5%. But look, some of that was certainly a bounce in the mega cap stocks, the Googles and the Amazons and those sort of stocks. So not getting too carried away by that. The Russell was also up 0.6, and the equal weight S&P was also a bit higher. So what will be the impact of this rather large tariff policy reset? And spare a thought for the bureaucrats in Washington who are trying to administer this washing machine of policy that has happened over the last 12 months. It must be soul-destroying. Nevertheless, there will be a very significant reset, and it's just a big blob of uncertainty at the moment. So let's just see how it plays out. There is no signs yet that the smashing in software, which I think is getting to ridiculous proportions, is showing any signs of ending. And unfortunately, the good stocks are being tossed out with the poor stocks. But there'll be a time when those good stocks will get recognised and we'll see a turnaround in that area, but we're not seeing any signs of that yet. The US dollar index was up a little bit, 97.8, which is surprising because we had a great deal of commodity price strength on Friday in particular, and that gets back to the alignment of all these drivers. It's just so strong that it's overwhelming what would normally be a bit of a negative currency impact. The 10-year yield was steady, just around 4.1, and the VIX index dropped a fraction from 20 down to 19. Let's go and look at some charts. This is the Nasdaq on a weekly chart. So you can see for the first time in about 4 weeks, we had a little bit of a bounce, but most of that happened on Friday night. As you can see, good strong session Friday night. So let's just see how that plays out. This is consumer discretionary versus consumer staples. We've been plummeting very, very sharply, but we got a little bit of a turnaround last week for the first week in quite some time. I still wouldn't write off the possibility of a rerun of 2022. It's just basically a day-by-day, week-by-week determination from me, and not just looking at this chart, because that just doesn't give you the picture at all. You got to look at 100 charts, 200 charts of individual stocks and sectors to get a feel about the sentiment of the market. Always good news. The semiconductor ETF is right up near its all-time highs. So nasty things don't tend to happen when that's happening. Let's look at the sectors now. At the top of the tree, we've got energy. So this is for the US. We've got energy, materials, and then we've got industrials making a real surge. We've then got staples in the middle and significantly outperforming the S&P. And then below the S&P, we've got all the more aggressive sectors of communication services and consumer discretionary and technology. And by stark comparison to the Australian market, finance right at the bottom, along with healthcare. So that's quite a different mix in some respects to the Australian market. So we'll look at the Aussie market, and materials continue to lead the way, but banks and finance coming up very quickly. So that's quite a deviation, and it's really just a reflection of the fact that the top 6 or 8 stocks in Australia just account for such a dominant position in the index. And there is much less choice in the Australian market. So we've got energy also starting to rise back up. And then we've got the ASX 200 sitting in the middle. So only energy, materials, and finance are beating the index. And then below that, we've got the communication services, we've got healthcare, which has been slammed, and of course, information technology. This is the S&P, a little bit closer to its all-time highs than the Nasdaq because it hasn't been sold off over the last 3 or 4 weeks to the same degree. There is the equal weight S&P, which is positive, hitting new highs, and the Russell also poised there, sitting at all-time highs as well. Let's just check in on the currencies quickly. This is DXY, so a positive week for the US dollar, which makes the rally in commodity prices that we'll get to in a minute even more outstanding with that currency. And also the Chinese New Year as well, meaning that the Shanghai Futures Exchange was closed. The Australian dollar, of course, is doing well in a strong commodity environment, and it's actually broken out and setting new highs. So this is quite a strong 3 or 4 weeks that we've had in the Australian dollar. And you can only really describe that as a new trend. All right, so just confirming on the Aussie Stocks, 70.15 is where we finished. It's trending now, and we're up about 11-12% year to date, which is a very, very significant move in currencies. Our index went up 1.8 for the week. Not sure what it'll do because of the overwhelming dominance of half a dozen stocks, but it doesn't really matter because we should just be focused on the individual stocks of interest for us. So it was a new closing high for the record. Materials, energy, and banks were leading, but the real action is way down the chain. It's in a whole raft of different small caps. So it's increasingly a market of haves and have-nots. And we've seen some very divergent performances in earnings season and even more divergent treatment from the market. And I guess the overwhelming theme from the Australian market is that if you disappoint the market expectations in any way, you are going to get slammed very, very hard. So let's go and look at some of the individual sectors in the Aussie market. So first of all, the ASX 200, there we sit with a new closing high. Materials on a weekly chart, trending up very, very powerfully. I'll go through in order of performance. There's energy starting to make a bounce, but as I covered last week or the week before, there is a huge divergence in the performance of our energy sector and the American energy sector when you put the two charts together on a relative comparison. Finance obviously doing extremely well and looking very positive, but healthcare has had its problems, particularly with CSL, but also some of the other large cap healthcare stocks, and information technology has struggled, but did manage a little bit of a turnaround towards the end of last week. Turning now to precious metals. So this is a daily chart. Now this is a big surge, silver up 9% on Friday night, and we're now starting to show the sort of resilience that you would expect. We've found a base, we've been churning around, the volatility is settling down, and then we start to charge off again. And when you look at a lot of US producing silver stocks in particular, but also gold stocks, they're either setting new all-time highs or they're very close to new all-time highs. They are really starting to outperform now, and I think the penny's dropping with the market that these are just cash printing machines now with commodity prices where they are. So this has raised the probability around precious metals. It doesn't make it a slam dunk, but the probabilities have risen significantly with that move, that we've now seen the base and we're likely entering the next surge in precious metals. And you really get that flavour of it when you look at 20 or 30 different US stocks in precious metals, not just from the commodity price chart. This is gold. It's been stronger than silver throughout. It only really had one day and almost another second day within its support zone. But since then, it's formed a higher low and is looking extremely positive. So the outlook for precious metals looks just about as good as it gets. There's the gold price in Aussie dollars. So finishing the week at just over 7,200. So recapping on precious metals, it was up 1% for the week, 5,108 is where it finished. Silver was up 9.3, despite the fact that the Shanghai Futures Exchange, where a lot of the speculative activity was happening, was closed. So that was a surprise. I thought there would be a steady drift to the downside during the week that the exchange was closed, but it actually finished on a bit of a rip-roaring high. And then you can add on top of that the fact that platinum and palladium also are breaking out of their consolidation zones, so their charts look very similar to gold and silver. And also, if you look at all the minor ETFs in America, so you look at GDX, you look at SIL for silver, SILJ for the silver juniors, then they're all doing the same thing. They're all breaking out of a consolidation zone. So all of those things are coming together. It doesn't guarantee that we'll now get a renewed surge, but it certainly adds weight to it. And when it comes to commodities, it's the volatility that's just as important as the trend. So clearly the big picture trend is up, but the volatility is what derails many investors. It's what catches investors out. They tend to wait until the narrative is positive, until the price action has been racing to the upside for a while, and then they buy, and they buy somewhere near the peak, and then we get a sharp fall in consolidation, which is just natural and normal, and the narrative flips over to, oh, well, we've seen the peak. And it makes it extremely difficult for inexperienced investors. So you need a better plan than that, than just following the news. We've got gold as a replacement for US bonds, which I've talked about a lot, and also as a hedge against just all the uncertainties around the world. And now with this Supreme Court decision on tariffs, it just adds another huge layer of uncertainty. GDX listed on the ASX was up 4.3, but it'll be a great surprise if we don't get quite a strong session on Monday in the Australian market. And GDXJ, which is listed in America, was up 4.2% after dipping a reasonable amount earlier in the week. So let's just go and look at those indices. So first of all, GDX in Australia. This is on a weekly chart, so we were higher, but I would expect that we should get some real strength on Monday morning. and this is GDXJ listed in the States, also pretty strong. And just a point on these GDXJ and SILJ, while their official name is juniors, you will find that they're very heavy in actual producing stocks themselves. So they're not juniors in the sense that we understand it. Oh, and just on the gold mining sector and the silver mining sector, it's really a case of just all the stars just aligned, no matter what time frame you look at, whether you're looking at the next month, the next 3 months, the next 6 months, the next 5 years. All the fundamental stars are aligned, and certainly the charts are supporting that. Other commodities, copper was up a little bit, back to 587. It was pretty volatile during the week, got down under 570 at one stage. So you just need to devise a plan to use the volatility to advantage. Don't buy into news events. Don't buy into a strong surge for the last several weeks. So get a better plan than that. And then when the appropriate signal comes, act decisively, because generally you don't get more than a day or two's grace in terms of entries. The market's moving far too quickly these days. Crude oil was up to 66.3, and XLE, which is the overall energy ETF for the US, is in week number 4 of a major breakout, and well in excess of the Australian energy market. So just be aware of seeing that, what's happening in the States, and then going looking for possibilities in Australia, because when you line them up against their American peers, they've been underperforming for several years by a big, big margin. Just have a look at the chart of XLE superimposed over the chart of Woodside or Santos, for one example. All right, there's the spot copper chart. So we're just consolidating here between 570 and 620, but the long-term trend is up. I thought I'd put in some other charts this week. This is spot aluminium, so also consolidating after a bit of a surge above 3,200. This is platinum. Got to 28.50, pulled back to 2,000 along with gold and silver, and is also starting to bounce as well. And crude oil also, we've got a short, almost becoming medium-term uptrend. So the final message is, and there's only so many different ways that I can say, get a plan. I've been preaching that for 10 years or more. So I'm sure many long-term watchers are getting a bit over it. But it's just so important, because I still come across 9 out of 10 investors who don't have a plan, don't really have any structure to what they're doing. So I think the thing to realise is that this is truly the opportunity of a lifetime in the next decade. I've never seen so many stars aligned for so many sectors all at the same time. And it's because of all these megatrends occurring concurrently. But having said that, if you don't have a really tight plan and you haven't really pondered who you are as an investor and therefore what style suits you, it is still really, really easy to mess it up and end up, not getting any sort of real performance or even losing money. So don't think just because we're going to have the opportunity bull market of the decade ahead of us that guarantees you're going to make money, that all boats are going to get lifted, because our psychology gets in the way when we get this level of excess volatility. So the thinking hierarchy around a plan is really, really simple. I've covered it many times here, and I cover it almost every week in the Insiders Club for members, just as a reinforcement. The harder part is getting that refined market perspective, which has to happen every week because things are changing so quickly. That is more challenging if you're not completely immersed in the market, as 99% of people aren't. So again, you need to put yourself in an environment where you can get that continually refined perspective on what's happening, when to play aggressively and when not to. So that's it for this week. There's more information on the website, and there's my email address, and I'll be back with you next Sunday. Cheers.